While retail investors panic, sell at the bottom, and chase whatever's trending on social media, billionaires are doing something very different. They're quietly accumulating, buying stocks that most people are ignoring, building positions that won't show up in headlines until the next 13F filing. Today I'm going to show you 5 specific stocks that the world's smartest investors have been buying. Warren Buffett, Ray Dalio, Bill Ackman, Stanley Druckenmiller. These aren't meme stocks. They're not AI hype plays. They're businesses with real cash flows, at prices these billionaires consider attractive. Now, before we dive in, I want to be clear about something. Following billionaires isn't a strategy by itself. They have different time horizons, different tax situations, different risk tolerances than you do. But understanding why they buy, what patterns they see, that's valuable. That's what this video is about. Let's go through each one. First, a quick primer on how we know what billionaires are buying. Every institutional investor managing over $100 million must file a Form 13F with the SEC every quarter. This filing discloses their stock holdings as of the end of that quarter. The catch? It's delayed. The filing deadline is 45 days after quarter end. So, we're always looking at positions that are at least 6 weeks old. This means you can't simply copy the trades. By the time you see them, the price may have moved, the thesis may have changed. But what you can do is study the patterns, understand the reasoning, see which businesses attract the smartest capital. That's how I use 13F data, not as a shopping list, but as a research starting point. With that caveat, let's look at the 5 stocks. Stock number 1, Occidental Petroleum, ticker OXY. Warren Buffett has been buying Occidental for over 2 years, consistently. Quarter after quarter, he now owns approximately 28% of the entire company. When Warren Buffett concentrates this heavily, the history says, pay attention. So, why Occidental? First, valuation. Occidental trades at roughly 6 times earnings. That's cheap for an integrated oil company, especially one with the asset base Occidental has. Second, the Permian Basin. Occidental owns some of the most productive acreage in America's most productive oil field. This is low-cost production, high margin, long reserve life. Third, carbon capture. This is the angle most people miss. Occidental is building one of the largest direct air capture facilities in the world. Carbon removal technology. If carbon credits become valuable, if carbon capture becomes mandated, Occidental is positioned to monetize it. Buffett isn't just buying an oil company, he's buying optionality on the carbon economy. Fourth, and this is classic Buffett, shareholder returns. Occidental has been aggressive with buybacks, reducing share count, increasing per share value. At 28% ownership, Buffett essentially controls the board's capital allocation decisions. He's engineering this investment exactly how he wants it. Risk, oil prices. If crude crashes, Occidental gets hurt. But Buffett isn't timing oil prices. He's buying a great asset at a cheap price and thinking in decades, not quarters. Stock number 2, Alphabet, the parent company of Google. Ticker GOOG or GOOGL. Bill Ackman's Pershing Square added a massive Alphabet position in the last quarter. He's not alone. Multiple hedge funds have been accumulating. The bull case is straightforward. Alphabet has a monopoly on search, over 90% market share globally. This is one of the most dominant business positions in the history of capitalism. They own YouTube, the second largest search engine and the dominant video platform. Google Cloud is growing fast and approaching profitability, and they're trading at roughly 19 times forward earnings. For context, the S&P 500 average is about 22 times. You're getting a monopoly with multiple growth drivers, trading at a discount to the market average. The concern is AI disruption. Will ChatGPT and similar tools replace Google search? It's a valid question. But here's what I think the market is missing. Google isn't standing still. They have Gemini, they have infrastructure advantages, they have data advantages, and, critically, they have distribution. Google is the default search on virtually every device in the world. That distribution moat is incredibly hard to overcome, even with better technology. Ackman is betting that the AI fears are overdone, that Google's core business remains intact, and that 19 times earnings is too cheap for that quality of franchise. Stock number 3, Taiwan Semiconductor, ticker TSM. Stanley Druckenmiller, one of the greatest macro traders of all time, has been building a position. The thesis is simple. If AI is real, and the computing demands are as large as everyone says, someone has to make the chips. That someone is TSMC. Taiwan Semiconductor manufactures the most advanced semiconductors in the world. They make chips for NVIDIA, for Apple, for AMD, for basically every company at the cutting edge of computing. They have a technological lead of at least 3 to 5 years over competitors. Intel is trying to catch up. Samsung is trying to catch up. Nobody has succeeded yet. The AI revolution runs on TSMC chips. Period. Now, the obvious risk. Taiwan. Geopolitical tension with China is real. Any conflict scenario dramatically impacts TSMC. But here's the counter-argument. TSMC is so critical to global technology that both the US and China have strong incentives to avoid scenarios that disrupt production. It's mutually assured economic destruction. Plus, TSMC is diversifying, building fabs in Arizona, building in Japan, reducing Taiwan concentration risk over time. Druckenmiller sees the same AI infrastructure build-out that everyone else sees. He's just buying the pick and shovel instead of trying to guess which AI software company wins. Stock number 4, Alibaba, ticker BABA. This is the controversial one. Ray Dalio's Bridgewater Associates, the world's largest hedge fund, has been accumulating Alibaba, along with other Chinese equities. Alibaba is probably the most hated stock in the world right now. Regulatory crackdowns, geopolitical tensions, economic uncertainty in China, everyone has a reason to avoid it. And yet, look at the business. Alibaba is China's Amazon, and then some. E-commerce, cloud computing, payments, logistics. They touch almost every aspect of Chinese commerce. The stock trades at roughly 10 times earnings, for a company still growing 10 to 15% annually. If this were an American company, it would trade at 25 to 30 times earnings. The discount is entirely geopolitical risk. Dalio's bet is essentially this. China figures things out eventually. The economy stabilizes, relations improve. And when that happens, Alibaba re-rates dramatically. Is this risky? Absolutely. I wouldn't make it a large position. But at these prices, the asymmetry is interesting. Limited downside from here, significant upside if sentiment improves. This is classic value investing, buying when everyone else is selling, having the patience to wait. Chapter 6, Berkshire Hathaway, 9 to 1015, stock number 5, Berkshire Hathaway itself. Tickers BRK.A and BRK.B. Some billionaires don't pick individual stocks. They just buy Berkshire and let Warren Buffett do the work. Here's why that's actually a smart approach. Berkshire Hathaway is sitting on $325 billion in cash. $325 billion. Warren Buffett, the greatest capital allocator alive, is waiting. He doesn't see compelling opportunities at current prices. But when the opportunity comes, when the crash happens, when prices get cheap, he'll deploy aggressively. Buying Berkshire is essentially outsourcing your market timing to someone who's done it successfully for 60 years. You also get exposure to a diversified conglomerate: insurance, railroads, utilities.
The Berkshire cash cow is here. Wow, perfect timing. Let's bundle your policy.
Music to my ears.
Consumer brands, a portfolio of wonderful businesses throwing off cash. It's not exciting. It won't 10 times. But it's probably one of the safest ways to compound wealth over decades. Some of the smartest family offices I know, they just buy Berkshire and don't think about it. Let Buffett worry about stock selection. Let me zoom out and show you the pattern across these 5 picks. What do they have in common? None of them are meme stocks. None of them are trading at crazy valuations. None of them require everything to go perfectly. They're businesses with real competitive advantages, real cash flows, real earnings, and they're priced reasonably, not cheaply necessarily, but not at nosebleed valuations where you need perfection to make money. This is how billionaires invest. They buy quality at reasonable prices. They think in years and not days. They ignore the noise. The retail investor, on the other hand, chases whatever's trending, buys high, sells low, panics at the wrong time. The divergence between these two approaches is why wealth concentrates over time. I'm not saying copy these trades. I'm saying study the philosophy. Understand why patient capital wins. Quick summary. 5 stocks billionaires are buying. Occidental Petroleum. Buffett at 28%. Cheap energy plus carbon optionality. Alphabet. Ackman loading. Search monopoly at 19 times earnings. Taiwan. Semiconductor. Druckenmiller's A. I pick and shovel. Alibaba. Dalio's contrarian China bet. Hated but cheap. Berkshire Hathaway. Let Buffett do the work. $325 billion waiting. The pattern, quality businesses, reasonable prices, long-time horizons. If you found this valuable, subscribe. I analyze market moves like this every week while most people are still reading yesterday's headlines. Link in description to see my actual portfolio. Full transparency. Updated weekly, you can see exactly how I think about position sizing and allocation. Comment below. Which of these 5 surprised you most? OXY, Goog, TSM, Baba, or Berkshire? I read every comment. Educational only, not financial advice. Stay disciplined. I'm Mark Kahn. Thanks for watching. For my breakdown of the 3-scenario portfolio framework, click here and subscribe for the next analysis.